How is everyone doing? Welcome back to another episode of The Banker Next Door. I am your host, Dr. Joe Berquist. Today, I wanted to talk to everybody about the 5 C's of credit. So when you are in the commercial side of banking, typically very early in your career, if you should come in on maybe the administrative or definitely the credit side of the business, you get exposed to what are called the 5 C's of credit. And what I wanted to look at today was an article that talks about basically the 5 C's of credit and ask the question, are they still important, and how technology is basically influencing those 5 C's today, and then offers some additional C's to be considered as, credit underwriting and credit evaluation continues to evolve into the future. So let's bring in this article here. So this article was written by a gentleman named Ken Summar, who's with one of the major core providers called Jack Henry. And again, the article is called "Do the 5 C's of Credit Still Matter?" And I wanted to run down here just something he says at the very beginning. The fact is, the United States runs on credit, and financial institutions must make correct credit decisions 99.5% of the time to remain viable, so they can A, serve their communities, B, provide a return on investment for their stakeholders, and C, facilitate financial transactions in a reliable, secure, and efficient manner for consumers and businesses. So just take a step back and think about that for a second. You have to be right 99.5% of the time. And he says, and he goes on to say here is that is a high threshold to maintain. And that is exactly right. And that's why, in some of the previous podcast episodes, I've always tried to make the point that it doesn't take much for a bank to go bad. In other words, if you've got, say you got 100% of your loans, you don't need 100% of your loans to go bad to kill the bank. I mean, if 5 to 10% of the loans go bad, that could kill the bank. I mean, and so you think about just percentages and what that means. So, I mean, you have to be right a huge amount of the time. You can't, and so I always find it interesting that customers and people have said to me in the past, hey, you're the bank, you're here to take risk. And it's no, we're really not here to take risk. We're here to take extremely calculated risks, risks that we can control through the 5 C's that we're going to see here in just a second. But so, and he goes on to say here, the 5 C's unpacked, early in lending careers, one is exposed to the concept of the 5 C's of credit. These concepts form a foundation of how and when credit decisions are made, and they are based on experience gained over decades of credit risk management. And that is so true. And it's what I've always said is that banking is as much a science as it is an art. So you got to have kind of the numbers side of things. And then you have to have, what you're seeing based on what's called soft information. What's the character of the person like? What's their relationship to people in their surrounding community? What's their reputation? But let's take a look here at the 5 C's real quick. So we have character, we have capacity, we have capital, we have collateral, and we have conditions. So character: do the business owners have a history of standing behind their obligations? Do they exhibit honesty, integrity, and other personal traits that nurture a strong lender/borrower relationship? Capacity: is the business generating enough income to accommodate the repayment of the proposed obligation? Again, what does that give? Another consideration for capacity could be cash flow. Is the company generating enough Are they profitable? Are they generating enough cash flow that you could, that is a bank's always our number one consideration. What is the cash flow? Does the company have enough cash flow? Collateral's great, but collateral doesn't mean anything if they don't have cash flow. Capital: have the business owners reinvested profits into the company and maintained a strong owner equity position in relation to their total obligations? Do they have owner's equity? When you look at the balance sheet, what does the owner's equity look like? Or, do the business owners kind of pilfer the company, so to speak? Do they suck all the money out of the company and put it into their pockets, and leave the company with very little in terms of operating cash and owners' equity and capital basically to work with? And I've seen that many times over the years. So, and collateral. As a secondary repayment source, does the collateral protect the financial institution in the event of default where liquidation may be necessary? So in other words, a lot of times when you're underwriting a loan, you're looking at like, okay, well, what are our layers, if you will, of getting repaid? The first one's always cash flow. Okay. Where, we all we want to do. And I cannot say this enough. Banks do not want your real estate. They do not want it. Banks, like, your lender is not in the property management business. They are not in the real estate business. They are in the lending business. They want to lend money and they want to get repaid. They do not want your real estate. I think so many people get in this mindset, or so many borrowers get in this mindset of like, oh, the bank's just out. They just want my property and they want to get everything I've got and this and that, everything. It's like, no, it's like, that is never, ever the case. A bank, first and foremost, all they want to do is lend the money and then have you make your payments and get paid back as quick as they can. That's it. However, unfortunately in life, things don't always go that way. And so there have to be other layers, so you look at cash flow, you look at collateral, and then you look at the individual. People always talk about, personally, oh, why do I have to personally guarantee or whatever? Well, part of it is a psychological thing. But the bank wants you to feel like you're on the hook for something. And part of it is also a kind of an honor and an integrity thing. Like, if you're not willing to stand behind this loan, why should the bank stand behind it if you're not willing to stand behind it? And then we get to conditions, like, under what conditions is the loan being granted? What internal and external economic factors are at play that could impact repayment of the proposed obligation? So again, conditions, highly important. Do you want to get updated financials every year? Do you require certain things at closing? Do you need an appraisal? Do you need environmental phase one? Do you need title insurance? Do you need insurance? Do you need to make sure that you have an insurance certificate naming the bank as a lost payee or lost mortgagee? Are you going to require them to have deposit accounts with the account? Do they have to have auto debit? All these things are important. Are you going to have other type of conditions? Are you going to have covenants in the deal? Are you going to require them to keep a certain amount of equity in the business? Are you going to have cash flow covenants? Collateral covenants, as far as like if you're doing asset-based lending and you're relying on accounts receivable and inventory to get repaid, are you going to have covenants on certain things there in terms of just the amount of inventory they keep on hand and how quickly they're turning things over, that kind of stuff. I mean, there's tons and tons of different types of conditions and covenants that can be put in on these different deals, but this makes up the core of underwriting at just about every bank in the country. You have to look at these 5 C's. And what's interesting here is we get into the technology piece now. What's interesting is that, technology, I've always said, technology is fantastic. And you look at your streamlined type of lending systems, an automated loan system, if you will. But the automated system, the one thing it can never do is it can never tell you the character of the person across the table from you. It can never tell you what is the, what's the person's reputation in the area. How much integrity and honesty does this individual possess? What is their family known for? Like that's the thing that a automated system can never do for you. It can never tell you these things. It can analyze all the other stuff. It can look at capacity or cash flow, capital, collateral, conditions. Like, you can pre-program it to do all that stuff, but it cannot and will never be able to tell you or explain to you character. All right, so let's go here. So now we get into increasingly digital. So the way we know and use technology in lending and credit has changed drastically over the past decade. New tools are being created and modernized constantly to improve and simplify the loan origination process while maintaining the credit fundamentals. So what he's talking about is an automated loan system. While loan origination systems and LOS emerged in basic forms decades ago, back in the 90s, New functionality has been developed in recent times to help meet the objective of simplifying a complex process through efficiency. The life cycle of a loan begins at application, moving to underwriting and closing, then to booking on a financial institution's core system. The loan and supporting collateral then need to be serviced and monitored over time, including any necessary maintenance along the way. Ultimately, it needs to be recorded as paid and hopefully enable the account holder to seek future credit using the history captured by the previous transaction. He says, woo, that's a lot to ask for one system. Yeah, absolutely. So in reality, there are many systems that need to work together in a coordinated fashion to make all of that happen. Collectively, they form an ecosystem to make the entire experience function properly, improve efficiency, and ensure borrower satisfaction with the relationship as a whole. And so again, I kind of addressed it. So he's absolutely right in what he lays out here in talking about like kind of the loan process, the ecosystem, if you will, all the different parts and functions to it as a whole. And while, yes, a lot of these systems are making this more efficient, can you afford to miss some of those 5 C's, or can you afford to not take some of those 5 C's into consideration in terms of if you want to keep your success rate at like 99.5%? So let's take a look here at what are some of the other C's that he offers. So let's see here. And the list is growing rapidly in the speed of technology. So compliance, not much need for further explanation here. Yes, we need a ton of compliance all the time. Consistency, same objective as compliance while adding in solid management tool. Convenience, choices are made based on convenience, including choosing an FI. Coordination, using APIs to allow multiple systems to interface and communicate manual to digital. Climate, similar to conditions, but includes regulatory and governmental restraints and direction. Core, using existing data to improve convenience at application and increase efficiency beyond. Cyber, cloud native technology to allow microservices, container orchestration, and scaling. And then finally, culture, maintaining an FI's values, beliefs, and norms. And I think out of all that stuff that he just listed there, the last one, culture, is absolutely the most important. There is no question. Culture is the most important. You have to maintain the values, beliefs, and norms of your financial institution at all costs, period, end of story. All that other stuff you can work with. You can work with compliance. You can work on consistency. You can work with core. You can work with cyber. You can work with convenience. You can work on all that stuff, but if you do not have the culture that basically is the roadmap for how you're going to handle all those things, it doesn't mean anything. So, and then he just goes on to say, conclusion, the more things change, the more things stay the same. The credit industry has and will continue to experience massive change to make the overall loan process simpler and the borrower happy about the experience. So yeah, and I agree with all that, but I think, I thought this was really cool. I thought this was a really cool article because I had been wanting to kind of talk a little bit more about basic underwriting, and I wasn't quite sure where to start or how I was going to get into that. And I thought that this was I saw this and I said, oh yes, yeah, let's start with the 5 C's. Let's talk about the 5 C's of credit. And again, so if you're a banker out there, if you're in the banking industry, I know you'll be very familiar with all of this information. But if you're not a banker out there, if you're maybe somebody who's just looking to understand a little bit more about banking and how banks underwrite and how they come to the conclusions and things that they do, hopefully this will give you a little bit of information there. If you're a student out there, maybe learning about finance or you're in college or high school or something right now, and hopefully this will provide you with some good information in understanding, well, how does everything go in? Everything, I don't care whether you're doing investment banking, whether you're doing commercial banking, retail banking, whatever, everything operates under a certain level of underwriting. When you open a business account, you go into a bank, I'm a small business, I got to open an account. What do you have to do? Oh, well, I have to provide certain documentation, and then I have to answer some questions for the banker, and then they're going to put this all together, and then I've got to sign some documents. It's the same thing. You come in for a loan. What am I going to do? Oh, I'm going to provide some documentation. I have to answer some questions. I have to go through the process, and then we're going to generate loan documents for you to sign. An investment banker. Oh, hey, we want to merge our two banks together. Oh, okay, well, let's get some documentation. Let me ask you some questions. Let's do some analysis. Let's crunch some numbers, and then let's put an agreement of sale together, and then let's get the lawyers in here and get this thing put together. Everything, I work for a mutual fund. What should we invest in today? Oh, well, let's see here. Let's underwrite, what's going on here. Let's look at some of these companies. Let's analyze them. Let's see what their financials look like. Let's go on some conference calls. Let's ask them let's ask the CEOs and the executives a whole bunch of questions about the company. And then we'll determine if that's a company that we want to invest our monies in. Same thing with an IPO. Like, okay, we're going to do this. Company comes to us and says, hey, we want to go public. We want to underwrite it. All right, well, let's underwrite the thing. Well, this is it. This is it. This is a 5 C's of credit. And the 5 C's of credit are always, these are never going out of style. These will always be. So I don't care how fancy the technology gets. I don't care how great it gets. I don't care how much AI you bring into it, whatever. They will always and should always be driven by the 5 C's of credit. What's the character? What's the cash flow? What's the capital? What's the collateral? What's the conditions? That should be the basic building blocks, the basic foundation of all of your underwriting and all of the systems that you have, how it should go through. But anyway, okay, so that's kind of my little bit of diatribe there at the end. But okay, I hope everyone enjoyed this episode. And if you did, please make sure to like, share, and subscribe. That always helps the channel. Please make sure to check out thebankernextdoor.com. And remember that we are on YouTube, Rumble, and all major podcast platforms. Please go and check out some of the other episodes that I have posted up, particularly the weekly banking update, because that is the main show on the channel. And I will see everybody again real soon. Thanks a lot.